So, everybody's welcomed this evening, our evening section. I hope today we're gonna get chapter 8 done. We were able to finish chapter 7 in the morning. And on chapter 7, we talked about life insurance underwriting and policy issue. We were able to note that why underwriters was introduced into insurance business. We said it was due to prevent adverse selection. We went ahead to talk about policy issues, applications, writing of applications, submission of application, and return of return receipt and statement of good heads. We talk all those. We talk the difference when application is submitted with premium, initial premium, and when application is not submitted with initial premium. We go ahead to talk about consideration clause in terms of the insured and in terms of the applicant and the terms of the insurance company. We discuss again this risk classification of which the underwriters use to determine their premium. We talk about the 3 types of risk classification: preferred, standard, and substandard. We discussed again in that morning about what we need to do and how the factors needed for such risk classification. We talk about the age, we talk about gender, we talk about health condition. We now talk about the materials that the underwriters will need in knowing what to classify. And the risk you'll be classified to. We said the underwriters, we need to know your sex, we need to know your age, we need to know your health condition through APX from your primary doctor and MIB. They got those information to be able to place you where you're supposed to be. And we know also that the on the 3 classes of risk, the preferred have a lower premium, 15% of premium less than the standard. The standard is the normal premium. And we also know that the substandard is 75% higher than standard. So I think that is pretty much what we discussed in the morning. That's what we discussed in the morning. There's one issue again about the substandard. We said that the substandard is the highest of all the risk. If they cannot be able to classify you on your risk, if you are above below the substandard, definitely they're gonna deny you policy. So to pay less premium, you have to be preferred. And to pay second to lowest premium, you have to be standard. To pay the highest premium, you have to be substandard. So I think that's basically what we discussed. Any questions before we move ahead to chapter 8? All right, so once again, good evening and welcome. Today we're gonna deal about chapter 8, and I know most of you is now preparing to come to Dallas. I know definitely some of us we see in Dallas on February 5th to 7th of February, 5th to 7th of February. Royal staff judiciously promised to provide you your hotel accommodation. So what you need is just to buy a ticket and let us know that you have got your ticket. Hotel accommodation should be made available to you. I think that February is the time for you to know everybody. Everybody gonna do business with you. I will assist you in make sure that you grow. Here, everybody grow together. You have people that will help you. So you're gonna see them, you're gonna know them. People you can call when you need help. So you're not gonna be on this business alone. Everybody gonna join together to make sure that you win. So don't be afraid of, oh, can I be able to do this? No. People will hold you at your hand, make sure that you succeed. So Dallas is the best way for you to do that. And of course, we talk about product guides. You come to Dallas, you can be able to see all those insurance companies, the providers. You see them, you can be able to get one or two provide guide from them that you can use to speak to your clients. And as a new person starting on the business, I will advise you to be in Dallas. It will help you. Whether you pass the exam or you don't pass the exam, you have made up your mind to be in the business, and that's the reason why you're here. So whether you pass or you don't pass, that should not be a factor for you not to be in Dallas now. When you come to Dallas, that will push you to understand and put it into practice. So today we're going to go to, this evening we're going to go to chapter 8. Group life insurance is one of the ones that all of us have a job. In fact, everybody, including me, I have it at job. Group life insurance. I have group life insurance when I was working. And you will not know what it is until definitely you come out of work. You will not know. So one thing that has led everybody to doing some job, even they don't want to do, is because of the benefit attached to the job. And one of those such benefits is group. They tell you that they have insurance, they provide you insurance. Whether health or life, that's one of the basic things they will like you to know that they provide you for. More especially, we do have some questions to ask, which we do not ask because we don't know. So, for instance, if your company is providing you health insurance, I think one of the questions you ask them is that, are they going to contribute to that? If they're going to contribute, how much are they going to contribute? That's a good question to ask them. If you don't ask those questions, you just take whatever they promise you, you may turn out to see that the other job you would have gone to is contributing greater percentage than what the job you're into will contribute. So that'll be a factor that you have to consider before jumping into the promise of giving you an insurance. So let's go to group life insurance. The insurance you get at work is quite different from the one you can get by yourself. The previous one we have been speaking about, buying a policy, is different because this one is, apart from its group, it contains a lot of things that you have to fulfill. For instance, if you're working with that company, that gives you the qualification to get the policy. Nobody will come to your house to assess your health condition. Of course, no. Nobody will ask you one question or the other. They will just sign in, and there you get the policy. But another issue is that what kind of policy is it? You have to be defined. You have to be able to define the kind of policy it is. For now that you are here, you can be able to explain to yourself and to others that, look, what did I have? What is it? So today you're going to be able to know what you have and what it is and the questions surrendering it and what it will be when you leave your job. So let's go to the group life insurance. So let's see, have you ever wondered why employers offer life insurance as a benefit? That is a simple question that all of us should answer. Have you ever wondered why employers offer life insurance as a benefit? Or why joining your company's group plan might be easier and less expensive than getting coverage of your own? So that is a good question to answer. Have you ever wondered why employers offer life insurance as a benefit? Why? And why joining your company's group plan might be easier and less expensive than getting coverage on your own? Can anybody say something on that? Why do they give it as an offer for benefit when you join a job? Can anybody put, all of us here is working as a staff one way or the other. Do anybody know why?
Say that again.
I said, do anybody know the reason why employers offer life insurance as a benefit?
It's attraction of staff. It helps them to attract staff.
Employees, I think.
Yeah.
All right. So I think that's a good question. I mean, that's a good answer. The best thing is for them to, it sells their product.
Hmm?
I mean, it says the company's product. What I mean by it says their product is the offer of life insurance, market them to
Yes.
employees. So it becomes a source of attraction. But one thing we do not ask and one thing we don't know, we do not know is this. What is in there in that policy that they want to give us? It's free. Of course, you contribute to it, and some of them, the company contributes to it. So that's questions we do not ask. We just take it as we say it without knowing what it is. Of course, it's term life insurance. That is the truth. It is term life insurance. So it's just like the policy, the term life insurance you go elsewhere and buy. That is basically what it is. It's term life insurance. It does not have any benefit, sort of. It doesn't have any cash value. It's just a simple term life insurance. That is basically what it is. So it may be as cheap as it is. Even if you are doing a single, it may be cheap. I'm telling you. But the only good thing about it, the only thing I have seen, I just get out from my job. The only thing about it is this. If you come out from it, after that several years you have worked there, you can convert it to individual whole life policy with cash value. Just like term life insurance, if you come out of the policy terms, that is, if you reach at the years you bought, for instance, 20 years term, you reach at that 20 years, you're gonna renew. It's renewable. When you're going to renew, the premium will be based on their new age. So, but this one, when you come out of job, you said you want to convert it to individual. The premium will be almost 10 times what is 10 times? Almost 20 times more than what you are paying when you are a job. So it becomes difficult, just as when you are in term life insurance, you want to renew it. It's almost the same thing. So for somebody who come out of job from when he's 65 or 70, believe me, he cannot be able to convert it, because even if you convert it, you cannot get any money. You won't be able to afford it. That's the basic truth. You won't be able to afford it. If you are out of job, if you leave that job, maybe when you are before 60, before 55, around that kind, 53, 54, you will be able to afford it a little bit. But believe me, at 60 years, you can't afford it. So basically, it's the same thing as compared to the simple term we are buying, the level term we are buying. So it's just the same thing. So they offer you that policy, a job, to attract you to work with them. Then, of course, the law says they should give you the certificate. They should give you the certificate. Why them? The company will hold the master contract. That's what the law says, and that's exactly what it's supposed to be. The master contract should be held by the employer, while the certificate should be held by the insured. And who is the insured? You, the employee. But the company does not do that. What they do is that they hold both the master contract and the certificate. So you have a policy, you don't know exactly what it is. You don't know the readings on the policy. You don't know what it is. Some people just sign in. They have not even logged into their profile at the company to be able to check the policy and check the amount it is. I was a victim, actually. I don't know what I did. Even to a point, I do not know that I even signed in and signed disability insurance. I do not know. They were taking money from my paycheck. I did not know that I signed in for disability insurance until when I get out of the job, when I retire from there, when I want to convert from the group to individual whole life with cash value. That's when I found out, when they begin to send me letters, when I found out that, look, oh, I have disability insurance. I did not know before. So, but if a certificate of that insurance was given to me, I can be able to know what I have. But based on the companies and their things they do, they don't offer you those, they don't give you those, then it becomes difficult for you even to know what you have. So the only way you can know is you have to pay attention, log in, pay attention, go through what you sign in and find out what you sign in. Person like me, I do not care about those things until now that I've come into this axis, that I've come to know everything about retirement. That I've come to know that life insurance is something that you should take as important as every other thing. That's the only time I was curious to know what it is. And of course, it was late. But for some of you that are still working, let it not be late. Go in there and find out what you have. Ask some intelligent questions that will redirect you, that will help you to make corrections if it's necessary. So today we're going to start from group life insurance. We're going to talk about, I think, a little bit about health aspect of it. So the reason why they offer you that was actually it's just like a marketing their company to make it more attractive to you. Just as you bought a policy, you put riders on it, you want to make it more beneficial, more attractive to you. That is exactly what the employers are doing to the employee to make the company more attractive to them. Looking at it, it does not contain anything. If you do not have that one, you go ahead and buy term life insurance. Of course, term life insurance, level term life insurance you buy on your own, you can still convert it to whole life. Of course, you can do that. You can convert it, but the only thing that company says, some of the insurance company will say after 5 years, after 3 years, after those years. So after that years pass, you cannot be able to convert it again. So that is only the ugly thing about that. If not, it's just the something. And they take more money from you, more than what they used to buy term life. All right. So imagine you have started a new job, and during the orientation, your HR manager mentioned that you are eligible for a group life insurance. You you are handed a certificate stating that you have 50,000 in life insurance. I don't know if anybody here has received a certificate. That person should let me know, should let us know, so that we go and ask our companies why they have not given us our own. If anybody have received certificate of insurance or certificate of protection, life insurance protection he has in his job presently, the person should let us know, please. So you do not have to take a medical exam or answer detailed health questions. Of course, no medical exam, no detailed question. Even in term life insurance, you can do it with term life insurance. They don't ask you of any medical exam. Who have term life insurance? Nobody asks you any medical exam. They just buy. However, presently we have term life insurance with living benefit. Yes. Presently, you can write term life insurance with living benefits. We have some. So that is what it is. So this is a scenario. This scenario what illustrates one of the many advantages of group life insurance that we will explore in this chapter. Group life insurance is a fundamental part of many employee benefit package and provide essential financial protection for millions of Americans. Unlike individual policies that you might purchase directly from an insurance agent, group life insurance covers multiple people under a single contract, typically at a lower cost and with fewer restrictions. I don't see any fewer restrictions. I don't see any lower costs. By my experience from what I know now, I don't see. But however, it's not obligated that you should leave it. It's something you should embrace if you have it. But the only question will be, is it contributory or non-contributory? That's one of the questions you're going to ask your employee to know exactly what you have, whether it's more beneficial to you than going individually buy term life insurance. So in this chapter, we will examine how group life insurance works, who is eligible for coverage, and what happens to your protection. If you leave your job, we will explore the differences between plans where employees contribute to the premium cost and those fully paid by the employer. This is another issue that you have to find out from your employer. If you are going for an interview tomorrow, you go for interview for 2 places. Probably you are offered appointment in 2 places. One of the questions you say, 2 of the places may say, oh, they're going to offer you group life insurance. They're going to offer you life insurance. Yes, agree. But ask each of them, say, this life insurance you're offering me, is it contributory or non-contributory? Are the employers going to contribute to it? Or the employer is not going to contribute to it? Let's assume company A say, yes, our employer is we are going to contribute to it, which means you're going to pay part of the premium and the employer going to pay part of the premium. If two of them answer that question, come again and ask them, how many percentage are they going to contribute to the policy? So based on that, anyone that offer you the highest percentage, that's the one you get to go. Because if company A say, oh, we're going to offer 50%, company B say, oh, we're going to offer you 65 or 75%, please go to one that will offer you 75% contributing, which means they are going to contribute 75% of the premium. You are only going to pay 25% of the premium. So go to that one that will give you 75%. The other one saying will give you 50% is not better than the one that will give you 75%. However, you still have to check other things attached to it to know whether it's favorable to you or not. So that is basically what we're going to see in this chapter. It's a very interesting chapter. I so much love it because personally, I have had the experience, have been able to convert, leave the job, convert from group to individual. I've been able to see the disability insurance. I've known what it is in terms of converting, trying to bring it to an individual life insurance. Even the health insurance too. I was able to convert my health insurance for my children to an individual. So all those are now, I'm telling you from a first-hand experience. All right. So let's watch this video. This video is about the group life insurance. How many minutes? About 3 minutes, 26 seconds before we go to the chapter terms.
Welcome to the Group Life Insurance chapter. In this chapter, we'll explore why group life insurance is a cornerstone of employee benefits and how it provides essential financial protection for millions of Americans. Have you ever wondered why joining your company's group plan is often easier and less expensive than buying coverage on your own? Imagine starting a new job and being handed a certificate of life insurance, no medical exam, no lengthy forms. That's the power of group life insurance. Group life insurance covers multiple people under a single contract, typically at a lower cost and with fewer restrictions than individual policies. By the end of this chapter, you'll be able to explain the differences between individual and group life insurance contracts, identify key characteristics like policy ownership, certificates, and master policies, distinguish between contributory and non-contributory plans, describe eligibility requirements for groups and members, explain group underwriting and conversion privileges, compare types of group life insurance, including credit and blanket life, describe coverage for military and federal employees, and finally explain the tax treatment of premiums and benefits. Let's start by understanding the principles and characteristics that make group life insurance unique. Group life insurance is usually provided by employers, but can also cover other groups like unions or associations. It's most often written as annual renewable term insurance. Unlike individual policies, the employer owns the master policy, while employees receive certificates of insurance. There are two main types of group plans: contributory, where employees contribute to the cost, and non-contributory, where the employer pays the entire premium. Eligibility matters. Groups must be formed for reasons other than just buying insurance, and employees must meet certain criteria, like being full-time and actively working. Underwriting for group life insurance focuses on the group as a whole, not individual health. This leverages the law of large numbers to balance risk and keep costs low. A key feature of the policy is the conversion privilege. When an employee leaves their job, they may convert group coverage to an individual policy, no proof of insurability required. Beneficiary designations are important. Although the employer owns the policy, it is the employee or agent who selects the beneficiary. There are special types of group coverage, like credit life insurance for loans, blanket life insurance for specific hazards, and government-provided plans for military and federal employees. Understanding group life insurance is essential for insurance professionals and anyone wanting to make informed decisions about workplace coverage. So get ready to master group life insurance, knowledge that helps you guide clients and make informed choices for yourself. Keep going! You're one step closer to passing your exam with confidence and helping others secure their future.
All right. So let's look at the keywords. This chapter is very interesting because the chapter affects all of us, more especially for some of us that are still looking for a job and for those who are already on the job. So we want to know what we have. So let's start with a blanket head policy. What is a blanket head policy? It's a policy issued to cover a group that may be exposed to the same risk. A policy issued to cover a group that may be exposed to the same risk. This kind of policy can be, you can have it from groups such as school, students, for instance, basketball team in the school, they can have this blanket head policy. It's a policy that the school can buy. It covers those who are in basketball team. If anything happens, is what the kind of risk they have is injury. It specifically covers for injury. If they go for any game, any injury come up, if they have a blanket head policy, it's specifically covered for it. So they are exposed to the same risk. My son's school, they have this blanket head policy. So he had a cut when they are playing basketball. So he went to hospital. I went to the school to take him to hospital. So he has a cut on the face and they do stitches. So they called me, they were asking me that there's a plan that he can be covered because he's playing basketball in the team. So that's a blanket head policy. It's a policy issued to cover a group that may be exposed to the same risk, but whose composition, that is the individual within the group, is continually changing. Of course, basketball team in a school is a special type of, in fact, is the basic example of blanket head policy. That policy is a routine. After they left, if they leave their own class, go to another class, is another people will take over. The same policy continue. So it revolves, it changes. The people that is covered by it changes. The middle school basketball team has their own. The seniors has their own. So it revolves around. So a blanket head plan may be issued to an airline or a bus company to cover its passengers, or to a school to cover its students, of course. So unlike group insurance, no certificate of coverage are issued in a blanket head plan. That one is just a written statement in terms of those who
he's about to order the new water machine.
I am in my class.
Oh.
So it basically covers those who participate on such thing. For instance, those who are in basketball, for instance, an airline, that's a blue blanket heads policy. That's what they have. Certificate of insurance. Of course, I said this before. Certificate of insurance in group life insurance, an ideal group life insurance, an ideal one. You see what I said, an ideal one. The company owns the policy, and that's why they should be given a contract. They should hold the contract. And you, the insured, the employee, should hold the certificate of insurance. That is how it's supposed to be. But I think reverse is the case. They are not even reverse. I don't think it's applied in any of the companies. So certificate of insurance is a document issued by an insurance company or broker that verifies insurance coverage granted to individual under specific condition. With group insurance, the group, typically the employer, is the policy owner. Your company owns the policy and maintains a master policy. The insured, typically the employee, receive a certificate of insurance rather than a policy. So you can see what the law said here and what the definition of group life insurance, of which what is going on in our companies, the heavy promise of I provide you insurance. In this sense, the company is the policy owner. The employer is the policy owner. And they should maintain the master policy. Of course, there's a master policy. And you, the insured, should receive a certificate of insurance. You're not going to go and ask about the master policy. You don't need it. What you need is the certificate of insurance showing that you are a participant in that group. That's what it's supposed to be. But I don't think any company operates that. If I'm in Congress, this is what I'm going to raise up, you know. I don't think any employee has ever gotten certificate of insurance from their company, except the executives. Who knows, maybe the executive have it. So we now come to contributory plan. Yes, you have a job and the job said, oh, we are giving you insurance. In fact, if you go the way the interviewers, all those HR, the way how excited they are to tell you that, look, they have a policy, insurance coverage for you. They are as if they are giving you heaven. I don't know whether some people have experienced that. When you go for interview, how excited those HR people will be telling you that, oh, we have a policy, we have a company that offer group life insurance for our employee. What I want you to do today, if you go, in fact, you can still walk into your HR to ask them this question. You ask them, please, I know I have a group life insurance in this company. Is it contributory plan or non-contributory? What is it? Is it contributory or non-contributory? If it is contributory, what it means that the company is contributing to the premium. And again, if they say yes, it's contributing, then ask them this second question. How many percentage is the company contributing to the premium? That is what you should ask them. Because if it's contributory, as they said, and with at least 75%, in fact, with at least 50%, you will not be paying close to sometimes $100 and something taking from your money almost every month, or sometimes $200 taking for your money every month, or if more than 200 taking for your money every month because of group life, the policy they are giving you. If it is contributory, then you cannot be paying such amount. And if it is that contributing, how many percentage are they contributing for you to be charged the money they are charging you? They're taking for your paycheck. So all this thing, like in my language, in Igbo language, they say etigishi eburishi. So so what it means that they give you head, they cut the head again. I don't know who anybody Igbo here should say that well. I didn't get it correctly. Edishi eburishi. That's they give you the head, they cut the head again, something like that. So they give you that policy. They still take it back. They say they give you that policy, they still take the money back. The money they're paying you in this, they still take it out from you again. Yeah, because tell me, if that policy that you are paying every month, from your paycheck, every money, if it is contributory, even if it is not contributory, the amount you are covered cannot be able to be up to 200 or 300. But sometimes they remove close to 300 from your paycheck if you calculate it monthly. Yeah, if it is all right, if it is non-contributory, it cannot be able to reach that. Then if it is contributory, then how much are they contributing for them to charge above 300 in your paycheck every month? Can we begin to ask those questions? It shows that you know what you're doing. It shows that, look, it's not like before. Now you are at the center of your finance. Because if you ask all those questions, you can be able to determine whether it is better for you not to help out from it and go and get something good for your life, so that that thing that can continue, even if you leave your job, that to continue to pay money that is not is just not, you're just wasting the money is supposed to get from your paycheck. They're collecting and say they're contributing life insurance policy for you. So these are the things you have to get. Of course, if you're here, you have had your policy, you have index universal life insurance, you have some other policy types that can protect you even through your retirement. Is there any need for you to go and say you want to sign into group life insurance? It's not, I think it's not necessary. So, except you know what it is and can be able to categorically examine it, see whether whether the money you are spending on it is worth it or not. Then you determine whether you can go for it or you can leave it and go for get something that is good for you. If you have it here, you have up to 500,000 life insurance that you know has a cash value for you, you are paying. Is there any need for you to go and get that one that is term that you cannot be able to convert when you leave that job? Because definitely you're going to leave that job one day. You're going to leave the job one day. Can you be able, if you leave the job, can you be able to maintain it? Yes. These are the questions. Except you are not, you couldn't be approved in any of the policy you wrote. That is only your hope. Then you can continue to do it. Then in that case, you get to go into the policy and make sure you adjust it to your benefit when you retire. So that's a contributory plan. Is a group plan issued to an employer under which both the employer and the employee contribute to the plan's cost. That is contributory plan. Generally, at least 75% of an eligible employee must be covered by the insurance in most cases. The employee must contribute to the cost of the plan. That's contributory plan. You want to know how many percentage your company is contributing and how much you are contributing, how many percentage you are contributing to the plan if it is contributory plan. The conversion privilege. Of course, group life insurance give you the privilege to convert from group to a individual policy. So before an original group insurance policy expires, this privilege enables the policy owner to convert the expiring group coverage, usually group term, to an individual whole life policy. The insured is not required to prove insurability good health when converting a policy. Of course, that is only its good advantage. Remember, when you enter the job, they give you the plan. They did not check your proof of insurability. No. So when you're equally converting from that group plan to individual whole life with cash value, they will not ask you proof of insurability. They'll just calculate the money. If you look at the premium given to you, if you can be able to afford it, you go ahead. If you cannot afford it, you leave. Definitely, it's difficult. Believe me, I have the experience now. When you get to age of retirement, if I have reached the age of retirement, believe me, I may not be able to afford it. The reason why I did my conversion now, because I've not reached age of retirement, I still have the good age that can help me to convert it when it is fair. But believe me, if you are 60, if you are 65, if you're above 60, you retire, you cannot, except you have a good source of income. You cannot be able to pay the premium when you convert. So, credit policies. The credit policy, these policies are designed to help the insured pay off a loan. I keep on saying this. If you remember when we talk about credit insurance, we talk about credit insurance, we talk about decreasing term insurance, we talk about increasing term insurance. I told you that whenever you hear credit insurance, their mind should go to loan. It used to pay loan. Now, the basic thing about decreasing term insurance, it used to pay loan, but it's as sequenced as is seen in home mortgages. So that is why in any exam, you will see they write all types of policy. They ask you which of the policy is used in paying mortgage. Is decreasing term insurance. So please know that. They ask you which of the policy can be used in mortgage payment. Is what? Decreasing term insurance. Then they ask you which of the policy can be used in loan payment is what? Credit insurance. Please know that these are the two things you have to know. In case if they come to the exam, you see them in the exam. Don't get confused. Credit insurance is used for loan. Decreasing term is used for what? Mortgage payment. So credit policies, these policies are designed to help the insured pay off a loan in the event the insured passes away. It may not only be the event the insured passes away, so you should know that it is not only when the insured passes away, it's only so also used when the insured is disabled, when the insured can no longer be able to pay the loan. It's not only when passes away, it's also used when the insured is disabled and cannot be able to pay the loan. Then credit policies can be used to pay off the loan. The only good thing about it, or what I wouldn't say a good one, is that it doesn't have a beneficiary. The beneficiary is that company. And it cannot pay you, it has a limit it can pay. So just like decreasing term insurance, it has a limit. It equally does not have a beneficiary. When the person passes, or maybe when the person disabled cannot be able to pay the loan on his house, the insurance will step in. They will begin to pay from where the person stopped until they pay it out. On the loan, the same thing happens. If you are paying loan with credit policies, it's the same thing. There's not like beneficiary. The insurance company will step in to start paying where you left off. So the policies will pay a lump sum to the creditor to pay off the loan. Credit policies typically cannot exceed the amount of the loan, since that is the limit of the credit insurance interest in the insured. So this is very common. If today, probably, let's assume, Chinyere, let me use Chinyere as an example. Let's assume Chinyere now has maybe is a lender. Chinyere is a lender. And I came to her, I said, Chinyere, can you loan me 500,000? She said, yes, she can. So she turned around to say, oh, but I will lend you that money, but the condition I will use to lend you that money, because this money is not my money. This money is the money working for me, my business money. So because it's my business money, it's not my money. That's what Chinyere told me. Chinyere said, look, what's going to happen is this. I'm going to put you're going to put a loan on that you're going to put insurance on that loan. I will ask her, I said, why? He said, why I do that? In case if you cannot be able to pay it, at least the insurance company will pay me the loan, because this money is not mine. However, I'm paying her, let's assume $1,000 every month for that loan. So, but she gave me that condition that before she can give me that loan, I have to pay her $1,000 every month, and that loan must have an insurance policy on it. So I now begin to source for the insurance company that can cover the loan. I meet an insurance company, maybe owned by CH.8. CH.8 is the insurance company. CH.8 will say, all right, I will cover that loan with, you're going to be paying $500 every month to that policy for the loan. After CH.8 has gone through to check the criteria he set up for such loan, he said, I've calculated that 500,000 you owe. You have paid up to 400,000, remaining 400,000. I can be able to cover it for $500 every month. So I'll be paying the $1,000 I'm paying to Chinyere for the loan, and I'll be paying $500 to CH.8 as the insurance company. So suddenly, I couldn't be able to pay again to any of them. I couldn't be able to pay CH.8 the $500 for the coverage of the loan, and I couldn't be able to pay Chinyere the $1,000 for the coverage of the loan because of probable disability, or maybe anything serious happened. I'm no longer around. You know what Chinyere will do? Since I have paid up to 400 remaining, Chinyere will go and meet CH.8, the insurance company, say, Bart has this policy on the loan which I gave him, and now he cannot be able to pay. and the remaining amount on that loan is 400,000. So you say, all right, since Bat has the policy with me, my company is going to pay you the 400,000. We can pay it to you by lump sum, or if you want, we can be paying to you monthly. So in such loan, there's not like interest. In such loan, there's not like beneficiary. I mean, in such policy, there's not like a beneficiary. So either say we pay Chinye the money in lump sum, 400,000, or what is in the terms of the policy when I bought the policy from Shay, it can be pay every year 100,000, or pay every year 50,000, or pay every year 40,000, or pay every month $1,000. So that would be what would be in the policy terms. So whatever is the policy term I sign in is what Shay will use to pay Chinyere the remaining 400,000. So that is credit policies. That's credit policies. So let's look at franchise insurance. Almost you should know that whatever we are doing in this world is franchise. Walmart is franchise. Maradona is franchise. This business you are about to enter is also franchise. When is it franchise? When you grow to the level of SMD, it becomes your own franchise. When you become a broker, it becomes your own franchise. Remember, we discussed about broker. We say broker only work for the benefit of the insured, while the agent work for the insured and the insurance company. I think that's what we said. So you climb to a broker, you're only working for the insured. You are not concerned of the insurance company. You are not answerable to the insurance company. So when you become a broker, you have your own franchise. In fact, the target of everybody in this business is to one day to become an SMD. Is the highest ranking benefit you can get in the company. So everybody's target is to become an SMD. Of course, they went ahead to say if you become an SMD, you will have shares in the company. It's a great thing that people are fighting for. A lot of people are there and a lot of people are getting it. When you have a share in a company, you become part of the company. If the company is doing good, you are benefiting. So a shareholder, to become a shareholder is not one set thing. You have to have a lot of money to go and get shares, to buy shares. So I think from marketing director to become a shareholder in the company, they give you some shares. So that is franchise. Is a life or health insurance plan that covers group of individuals with uniform policies through the benefit. Although the benefit may vary, solicitation typically takes place in an employer's business with the employer's consent. Franchise insurance is generally written for groups that are too small to qualify for regular group coverage. This policy may be referred to as a wholesale insurance when it involves life insurance. So franchise insurance, most of those companies, they have their insurance too. So master policy, I've said the master policy is the contract policy. It's something that the insurance company, the employer normally get. That's the master policy. While the employee will have the certificate of insurance. So this policy is issued to the employer under a group plan and contains all the insurance clauses that define employee benefits. So let me tell you guys one thing that I discovered. When I resigned from the job, and I'm trying to convert the group life insurance to individual whole life, I was asked, how much is the policy? I was asked, what is the policy number? Of course, believe me, nobody should laugh. I do not know. And of course, partially, you may not blame me because all those questions are contained in the policy certificate. That is where you see them. Some of us that have policy today, go back, bring out your booklet, go through it, go to the policy summary, go to the policy certificate. You will see it there. The amounts, the coverage, what is there, what is covered, the policy amount, the policy coverage, the type of policy, everything. You see it on the policy summary. So they asked me such question. I said, I don't know. The lady began to laugh. The lady began to laugh. Say, why? I said, I don't know. I said, at the point, I asked her, do I supposed to know all those? She said, of course. She began to laugh because you know what? In fact, we went further into a very serious discussion, At the point, I was trying to like bring her into the business. In fact, it was a continuous discussion. Almost every day, I would call her, we laugh, and I ask her one or two questions. Whenever I call for the business, I ask, is she around? If she around, they transfer me to her, then I spoke to her. So it was fun because some of the questions she asked and some of the things that come out from her mouth, I was just laughing. I said, why are these people using us like this? I said, why are they using us like that? So basically, sorry, please, sorry. So you will not know until you know. That's what all those things are. You don't know until when the time reach. So individual employees who participate in the group plan receives personalized certificate that outline the key highlights of their coverage, including their beneficiary designation. So all those is what will be there in the certificate. But if you don't have them, you cannot get those things. So another thing is non-contributory plan. Non-contributory plan. This is an employee benefit plan under which the employer bears the full cost of the employee's benefit. The plan must cover 100% of eligible employees. Employees do not contribute to the plan cost. I don't think any company is offering the employees non-contributory plan. Anybody who has non-contributory plan should tell us, please. Is there anybody who have it? Where your company is paying all the premium to the policy. Do anybody have it? So I don't think anybody have it. Now, where the company bear the whole paying the cost of the employees' benefits, everything. I don't think so. I don't think any company does that. Even the contributory plan, they will tell you that they contribute. Meanwhile, they are contributing zero. Some of them is contributing 2% or 3%. Some who are good enough may contribute close to 50% of the premium. You look at it generally, it just means nothing, honestly. But it's not discouraging people who are there already. You will understand when you come out of job. Persistency, as it pertains to insurance, persistency is the percentage of an insurance policy that remains in force after a specified period. Persistency negatively impacted by policies that are replaced by other insurer, cancelled, or that lapses due to non-payment. Companies with higher persistency tend to be more stable and profitable than those with lower persistency. Of course, in this business, there's persistency is a performance, is a measure of your performance. If you have a higher persistency, means what? You are doing good. If you have a lower persistency, it means that you're not doing good. It's even in this business. All right. So that's the terms in the policy. Any question before we jump into the main thing? Any questions? Any questions? All right. So let's look at principles and characteristics of group life insurance. Why do we have them and why is it necessary? It's a single contract, of course. It's just like when you buy ordinary life insurance. Ordinary term life insurance. The renewable term life insurance. That is exactly what it is, honestly. So if you go, let's assume you get a job today. They offer you that group life insurance. You ask them, is it contributory or non-contributory? They totally told you that it's non-contributory. You check how much is this before you sign it. Check how much it is. Check how much you want to sign into. Probably it's 500. Let's assume you pay close to $300 every month on the life insurance. You come out as an agent that you are now, you know everything. You come out when you come back from job that day, go to your computer. Put in your age, put in your date of birth, put in your sex, put in everything. Calculate term life insurance. Check on the design how much on that particular face value is that you can pay single-handedly. Let's assume they give you 250,000 for $300 every month. $300 every month. You are paying, I mean, the first amount is 200,000. May not be able to, for you to get up to 250,000 means that you are paying close to 600 or 500 from your paycheck every month. So if they told you that, you come back as an agent, you know everything now. Just do it, do the design using term life insurance, because that's what it is, renewable term life insurance, which is a level term. So you just put everything, you check your age, check your sex, check everything. Based on the amount they say they're going to give you 250,000 face value, and you pay $300 every month. You put the term, put it, check. If that $300 can give you up to 400,000 term life insurance, then nobody will tell you what to do. I'm not going to advise you now. You're going to advise yourself. You advise yourself the next thing to do. Whether to go for 250,000, where you are paying $300 every month, or whether to go to 400 to 450,000, where you'll be paying $300 every month. So it's left to you to decide what to do. Or to go and buy, instead of buying that, to go and buy index life insurance worth of $200,000, where you'll be paying $250 or even $300. You check which one benefits you more. So if to go and buy index 200,000 or 250,000, that you'll be paying $350 every month, I think I will go for index that I can be paying $250 every month, 250,000 for $350 every month. I'll go for it. I'm telling you. I will tell the company that I don't want that. Because that money, bring it out and use it to pay for your index. The index will be there until the person passes. Whether you retire or do not retire, that index is there. And more especially, that index has a cash value for you. So basically, what I'm trying to say is my own opinion. The one they give you at work, anyway, for me, my opinion is that I don't think it's useful to me, but other people may be good for them, for those who so much cherish term life insurance. Of course, some people will say, buy term and life insurance and invest the rest. That's use the sum to pay for your term life insurance and invest the rest. How many people have invested the rest? So group life insurance differs from individual life insurance contract in several ways. One of the differences between the two is that group insurance is most often comprised of annual renewable term life insurance. Group life insurance is most often comprised of annual renewable term life insurance. That is why every year you have to sign in to maintain the contract. You have to sign in to maintain the contract. They say, have you signed in? They give you from so month to so month to sign in. Is this not signing? There's one name. Is it renew? Not renew. There's one name they call it. Who can remember? Who remembers? Every year the company will say it's time to sign in or to. Who remembers what I'm trying to say? What the company tell you every year to do to your health plan or group life insurance plan?
Is it not to renew it?
Is it renew? They call it renew it or what?
I don't know. I don't have it.
Some people have it here.
I don't have it.
Can anybody help us? I mean, everybody here doesn't have it. Some people have it at job.
I don't have it. I know about the IUI and the Pro Life. So
Open enrollment.
Open enrollment, good. Yes, it's open enrollment. Precious have it. Yeah, it's open enrollment. It's open enrollment. That open enrollment is almost every year. I think it's every year. So it's annual renewable. What we have in our workplaces, what is annual individual annual renewable. That's what we have. Annual renewable term life insurance. That's what it is. So the group plan we have is what? Annual renewable term life insurance, because every year you have open enrollment. That open enrollment is for you to enroll again. So it's annual renewable. So in contrast, individual insurance contract may be either term life or whole life insurance. Underwriting is handled differently. Various types of policy provision are included in a group life policy. Group term life insurance, like all previously mentioned insurance contract, is two-party contract between the policyholder and the insurer. The policyholder is who? The employer. It's a contract between the employer and the insurer. However, unlike individual insurance, the insured is never the policy owner. The insured is never the policy owner. But if you get individual, you are the policy owner. The contract is between you and the insurance company. Since the employer is the policy owner or the contract owner, he determines what happens to the policy. He can decide to cancel the policy. He doesn't need to have your consent before the policy is canceled. That's the reason why when you get out of job. So based on that the policy owner, which is the employer to the policy, based on that, we have COBRA that give you the benefit of when you leave the job, you still have the right to control the policy. They give you almost 1 month to be able to convert from group to individual, where you now become the policy owner. So when you do that, then the insurance company will give you a certificate of the policy. They don't have anything to do with your the employee again. So the employer that provide the group life coverage pay all or portion of the premium and is the policy owner. In this way, if somebody is paying $300 every month from a paycheck, for a policy sometimes less than 200,000, less than 250,000, and you are paying $300 every day, every month, and companies still come out to say they are the policy owner, they are paying. What are they paying? What are they paying? So honestly, when you understand the game, look at all those things. In fact, you feel that you are being cheated all this while. You feel you are being cheated all this while. Yes, because you can use $200 or $250. Sometimes it may reach up to $400 because they're removing it every paycheck and they pay twice in a year. I mean, twice in a month. So basically, they are taking your money from your paycheck every month. If they are taking that, you see that how much they are removing every month can fetch you a better plan, a better policy. Is there any need to continue to keep it? They should stop taking from your money. You can go and sign out any policy that favors you. So the employer or plan sponsor receives the master policy contract. Of course, they say they are policy owners, so they receive the master contract. That's what the law says. So in contrast, covered employees or plan participants receive a certificate of coverage. Even if it's not been implemented, please know, and in case, for exam purposes, know that the group policy you have a job, even though you have not seen it, that you are the participant, that you should receive a certificate of coverage of that policy. And the employer is the contract owner, is the policy owner, so he should receive the master policy contract. So that's what you should know for exam purposes. Even though we do not know, even though it's not applicable, even though all of us are working here, have it, but none of us have the certificate of coverage. Know that as an employee in a company that have a group life policy, that you should have a certificate of coverage. They should give it to you. Then the master policy should go to the employer. So that's what you should know. And of course, they are the beneficiary because they are the beneficiary. They will tell you to put their own beneficiary. Of course, they say put your own beneficiary. But how are you sure that they are not the real beneficiary? Because most often, when anything happens, everything is paid through them. So the coverage provided and the duration of the insurance coverage, the covered employee or plan participant also refers as the certificate holder. So you, the employee, is referred as a certificate holder. If you, so please, for exam sake, just know that you are the certificate holder, you are the employee, even though you have not seen the certificate of the one that covers you. So the employer is the master policy contract holder. So eligible group include employee of single employer, credit union, labor union, and multiple employers group. So employer responsibility. What is the responsibility of an employer? The employer is accountable for selecting group coverage, maintaining records, and managing employee enrollment. The employer must what? Not engage in discriminatory practice, which when the plan, of course, more especially when the plan is non-contributory. Let not be that some of the people, some of the staffs are non-contributory and some are contributory. So that is what discriminatory practices. If there's some of them that are contributory, some of the employees are contributory, some are non-contributory, then that's where the problem is. Benefit schedules. Most employees will establish benefits schedules based on what? Flat benefit amount, earning salaries, or employment positions. So that is it. Incident of ownership, employee benefit selection, incident of ownership. Who owns the policy? Your employer. Who have the contract? Your employer. Who has the the certificate of policy? The employee. So I think that is what you have to own here. That some are contributory and some are non-contributory. The contributory plan means that you are contributing and your employer is contributory. The non-contributory plan means that you are not contributing anything, your employer is contributory, is contributing to only your employer is paying the premium. But the contributory plan, you are paying part of the premium and your employer is paying part of the premium. So the covered employee or certificate holder has an incident of ownership because it is the certificate holder, insured employee, who names the beneficiary, not the policy owner. So of course, because you are the certificate holder, what happened? They allow you to name the beneficiary. But to the listeners, I don't know. Anyway, let's leave it for sake of exam. The employer, for the sake of exam, the employer are the contract owner. They are not allowed to name the beneficiary. You are the certificate holder, so you name the beneficiary. That's why in your group life insurance, you name the beneficiary of that policy. Sometimes people put their wife, their children as a beneficiary of that policy. So in case if anything happens, those you name the beneficiary will receive the benefits, the proceeds from the policy in case the person passes. The employee may name the employer as a beneficiary of the group life policy, provided the employer has an insurable interest in the employee. So you can decide to name your employer as a beneficiary of the group plan if the employer has an insurable interest in the employee. Of course, based on what we say in the morning, does an employer have insurable interest on the employee based on what we said in the morning? Can anybody help us? Does an employer has an insurable interest in the employee?
Yes.
Of course. So employer
Yes.
has insurable interest on the employee. That's the reason why the employee can make the employer beneficiary. Of course, as the owner of the policy, he doesn't even need to ask you whether whether to make him the beneficiary or not. He just put himself as a beneficiary.
So, sir, you're saying that if an employee buy, the business will just make money off of the employee.
That's not what I
The
said.
employee has been slaving for them. They will still make.
That's not what I said. But Like my people will say, use your tongue to count your teeth. We are alive. That's not what I said. What I said is,
I have counted it. I have counted every.
what I just said is this. I said the certificate of insurance should be held by the employee, which is you. I asked the question, how many of us have they given that certificate of policy, which by law is supposed to hold? Then we go ahead to say, in the issue of beneficiary, because you hold the certificate, the employee holds the certificate, you can name their beneficiary. Of course, again, you can name the employer as the beneficiary because the employer have insurable interest on you. However, remember the employer is the policy holder or the policy owner. If he's the policy owner, he can name himself as a beneficiary. That's a fact.
And that is the reason why they don't give any of us that certificate. Only.
I don't know. I don't know. I don't know. So basically, it's left to all of us to decide what to do. Now, you see, the only thing that proves that you are in this financial industry now is that you begin to make some adjustments. Adjustment that can fit you, adjustment that suits you and your family. That's the basic truth. There are some things you are doing before or you're allowed to happen before, you're not allowed to happen again. We show that, yes, you are here. Of course, if I'm to get a new job now, I go to the company, they told me that offering me life insurance. The first question I will ask them, is it contributory or non-contributory? That's the first question I will ask them after the interview. They say, oh, Mr. Bad, do you have any question to us? I say, yes. You guys told me that from what I found out here, that you guys offer your employees group life insurance. They'll be excited. They'll say, yes. I said, oh, so that's wonderful. All right. Is that plan a contributory or non-contributory? Of course, they will say again, they'll be so excited to answer me, yes, it's contributory. I said, oh, if it's contributory, how many percentage are you people going to contribute? And how many percentage will the employee contribute? In fact, if you ask them this question, they will look at they will look at you, say, from where this person come from? If you ask their employer who is interviewing you, if you ask them this question, they'll start looking at you and say, oh my God. Oh my God. Because you have to know how many percentage is a contributory. In fact, you don't want to shake them much. If you shake them much, if you ask them again, who holds the certificate of the policy? You don't want to go to that extent. If you go to that extent, they will look fool because they may not know it. Yes, the interviewers may not know it because they are employed as you are employed. Basically, some of them, even greater percentage of them may not know that question. So if you go there, you are not shaming them. Because they may not know it, they may not have had the opportunity you have today to be hearing this, of course. So if you want to just disgrace, you say, oh, that's wonderful. Are they going to give me the certificate of the policy as a certificate holder? So if the employer is the policy owner and you as the policy holder, certificate holder, can... Sorry, please. Sorry, let me say. Sorry, please, let me call. Yeah, so sorry, please. So by what we discussed in the morning, if I want everybody to reason it the way you reason it and make your own personal conclusion, whether they are cheating you or whether you are cheating them, or who is cheating who. So if the policy owner is the employer, and the policy owner has the right to name a beneficiary in a policy, and in this group plan, you are the certificate holder, and the policy owner, you have insurable interest on the policy owner, which is the employer. Does he have don't you think that policy owner can name the beneficiary he wants on that policy, even though the law says that you certificate holder should name your beneficiary. You name your own beneficiary. Don't you think the policy owner has the right to name a beneficiary? Since he is the policy holder and the policy owner. That's the question. So it now becomes your own to decide basically what you want to do. So the employee may name the employer as a beneficiary of the group life policy, provided the employer has an insurable interest in the employee. I asked the question, does the employer has an insurable interest on the employee? Somebody say yes. Of course, that's what we see in the morning, that employer has an insurable interest on the employee. That is one of the criteria of insurable interest. We read it, we studied it in the morning. So therefore, the employer can name the employer as the beneficiary, and the employee can name the employer as the beneficiary. So if that happens, if that's the case, you see, you can see down in the example that the employer may have an insurable interest on a key executive who has 20 years of experience. So see where they put it now, 20 years of experience. However, the employer is not likely to have an insurable interest on the part-time clerk. Of course, part-time clerk does not have a full coverage, does not have group life plan in most of the companies. If you're in part-time, you are not included in group plan. I think I'm right. Part-time does not, most of the company, part-time, they don't include them in the group plan. So because the employer has insurable interest on the employee, that's why you can have key employee policy.
I have a question, sir.
Uh-huh.
So what is the purpose of taking? What is the purpose of them taking money off of our account for that term? If something happens to us and we will not get anything.
There's a policy. Why they're taking it? They're taking it because it is contributory. They're taking money or they're taking money from your account because it's contributory. If you have something happen to you, they will pay you money depending on how the circumstances of the happening of that thing that happened. Of course, most often what will happen is you should be on clock to show that that thing that happened while you're at work. Means that you are in clock. You have clocked in. So if you're not in clock, anything happened, it becomes questionable. There's a question to ask, what happened? And now that you're not at work, the policy covers you while you're at work. It doesn't cover you while you go your own holiday, driving anywhere, go your own work, or when you're not at work, you are driving around, you have an accident, and maybe the person passed. You do hope that policy does not cover you. It covers you while you're at work, such as a blanket policy. Remember, blanket policy, it covers a specific type of people in a particular environment. So the policy we have cover you while you are at job. That's the basic truth. That is the basic truth. So some people will ask, I'm yet to see, I've not seen, except some people have seen, anybody has seen can testify and tell us the truth that yes, it happens. Most times, when you are sick, when you are sick at work, they tell you to go home. I don't know whether anybody has experienced that. More especially, even those who are working in the hospital. When you are sick, the first thing they will tell you to go and clock out and go home, even though you are working at the hospital. When you are sick, you're working at the hospital, maybe they're taking you to emergency, they tell you to go and clock out. I don't know, have anybody witnessed that? You can explain to us. You are free to unmute yourself and tell us your own experience. You can unmute yourself and tell us your own experience, whether what I say is contrary to what you have witnessed and what you have seen. Somebody, you can unmute yourself and tell us experience you have witnessed so we can learn from it. Anybody? Anybody? We are 14 here. At least all of us, some of us are working. At least greater percentage of us are working. So tell us your own experience. You must have seen it, or you must have been around it when it happened. Some here are nurses. They must have experiences. They must have seen where it happened. Where you are sick, they tell you to go home, or probably they tell you to clock out, even when you are working at the hospital. Anybody have such experience should let us know.
I did have that experience, but I was not working at the hospital. I was working at the bank, and I started feeling nauseous and dizziness, and they told me to leave, to kind of go as soon as possible. By the time, I was trying to get out, I collapsed. So they took me, they took me, they took me to the emergency room.
Siam.
Yeah.
Siam. So, yeah, that is some of the things that we should do. In as much as we're rushing to go to the job, to go take the appointment, that's the questions we should ask. They can never hold you when you are sick, even in the hospital. The one that terrified me, even in the hospital, they want you to clock out before you be taken to emergency. Oh, yeah, you are working in the hospital, you are sick, they tell you to clock out and go. Meanwhile, you are in the hospital. The basic thing is to make sure you clock out. Even, all right, well, she's at work, and the first thing they tell her to go home. And when immediately you step out from that door, you are no longer in the clock. So anything that happened then, basically on your own. I have witnessed, I've seen somebody who died quite at the job. And I think that person get full benefits of everything on the group policy. The man went to the restroom to pee. He collapsed there and died, quite still at clock. Yes. So, but I've not seen another person who died and probably still gets who died outside of job and gets a full coverage a full right given to him, to her. So basically me, for now, from what I know, I will do all those calculations. I do those plus and minus. If it's beneficial to me, if it's not beneficial, I can go and get my individual policy. I'll use that money that I'm paying there, I'll use it to pay this one, which I know will benefit me quite even when I'm not working. That's the truth. That's a decision I can take now that I have known, I know things, at least a little bit of what is going on. So most times they will say, if you're not at work, if you're not in clock, so except you want to benefit from it, probably you go and clock in. If the person want to die, the person drive to the work and clock in and die. That is when all the benefit will be. You get all the benefit. So that's what we have to think about it. So that is for some of our brothers. When you tell them that, look, get a policy, they tell you that I have a policy in my job. Tell them they don't have nothing. If they start up that elevator when they are going home, they no longer have anything. If they step into that elevator, clock in, they have something. If they stay there 8 hours or 12 hours and clock out, they don't have nothing. That is the simple truth. That is the simple truth. That is basically the simple truth. So we should begin to let our communities know that that is the truth, so that everybody should go and have its own personal policy. Some of them, you ask them, you see how they will confidently tell you that, look, I'm covered. I have good policy in my job. It's ignorant that we tell them to make those such comments. They don't have nothing. All those ones I have when I'm working, do I have nothing there? I don't have nothing again. I left the job, everything go. The health insurance, I left the job, everything go. So if you cannot be able to buy your own personal health policy, then forget it, you don't have nothing. Most people work for more than 70 years because they want to have health insurance. Definitely one day you will leave the job. That is the truth. And when you leave the job, the capacity for you to pay for that policy will be zero. Will be zero. So wouldn't it be beneficial that you start on time to look for a black goat than to start looking for a black goat at night when it's dark? Yeah. You start on time to look for a black goat. Because if you want to look for a black goat, you got to look at it when there is still sun, light to see the goat. Because it's black. And when it's night, you can no longer see the black goat because the night and the black goat will be the same. So you decide, you go to a job, start to have a private policy, most especially a good policy that can give you cash value while you are still at that job. So even if you come out, let's assume you walk up to 65, 70 years, you come out. If you cannot be able to pay for that policy will roll over and start paying for itself. And believe you me, that policy will last throughout the whole of your life because it might last another 30 or 40 years. And if you retire by 70 years or 65 years, there's no guarantee that you're going to live again on this earth for another 40 years or 30. There's no guarantee. Yes, except probably God will give you a special grace. So in recent years, due to modification of said laws, many insurers have been permitted to include an assignment provision in group life insurance policy. Of course, any assignment must be submitted in writing to the insurer. What is an assignment? Can anybody tell us what is an assignment? What is an assignment? All of us did chapter 5 together. What is an assignment?
Policy.
Huh?
Selling out the policy.
It says selling your policy?
Yes.
It's transferring
Or transfer your policy to another person.
Oh, good.
For money.
It's transfer. Is when you are transferring your policy to, it's not for money. When you assign your policy, you assign the ownership of that policy to another person, which means you transfer ownership of that policy to another person. Means, remember, we have absolute assignment. Absolute assignment means that you have completely transferred every right you have on that policy to another person. Means you do not have any right on that policy. The new owner, which is the assignee, now have the right to that policy. Means that the assignee can now take a loan from the policy, make a withdrawal from the policy, change the beneficiary. All the power have been transferred to him or her when it's absolute assignment. So assignment is a transfer of ownership from one policy, from you to another person, or from another person to you. The person who transferred the policy is a signer. The person who the person who transfer is the assignee. Then the person who is given to is a signer. The signer is the person who transferred. The assignee is the person who received. So I think we did it on chapter 5. We should, all this simple thing, it's good to remember them. So we're going to talk about group insurance versus individual. In the underwriting, the individual policy, the insured must provide evidence of insurability. If you go now, you want to buy individual policy, you're going to show evidence of insurability. If you go to group, you're not required to show evidence of insurability. There's no individual underwriting. But based on no individual underwriting, the underwriting is done collectively in the group. So there is no requirement for evidence of insurability. But if you go to buy as a person, you're going to provide proof of evidence of insurability. That is for underwriting purposes. Policy ownership. We are talking about difference between group insurance versus individual. Policy ownership. With individual insurance, what the insured is traditionally also the policy owner. That is individual. You have the policy, you own the policy, you are the insured, you are the policy owner. In the group, you are who is the policy owner, the master who owns the master policy, which is the employer. So the employer becomes the policy owner. Then policy type, individual insurance can be of any previously discussed temporary or permanent insurance product. Of course, individual can be what? Permanent or temporary insurance product. What is the temporary insurance product? Anybody remember? What is it? Example of temporary insurance policy products. In case if you see in exam, temporary insurance products or temporary insurance. What type of policy is temporary insurance product?
Is that the term life?
Term life is temporary, of course. It's only one. Term life is temporary. But the only thing is that when you come to term life, which is a temporary insurance, you have three different policy types in term life.
The level.
The level, the
Increasing and
and
decreasing.
decreasing. So these are the three. And you should be able to know that the level is the most common one we are buying. Means what? The premium is level, the death benefit is level. Now, you go to the increasing, of course, that's the one we just said about loan. You go to decreasing, we said it's almost about loan, but also for mortgage. So these are the things you should know. If you know it like that, definitely, no question will come there, you fail. And if you go to permanent life insurance or whole life insurance, there's different types too, which are too many to remember. Different types. But if we follow the way we did it, a whole life has also three, I think, straight life. Can someone remember straight life and one? If you have your note, you can look at your notes. I can't remember the three offered now. But they are easy because there is three in term and it's three in whole life. Then based on three in whole life, we now begin to take them one by one. That's when you get to, until you get to traditional and non-traditional. The non-traditional is where we talk about the index universal life and index universal life. That's the non-traditional. So whole life, you have traditional. Traditional is about three types. Now the non-traditional has a lot of types too. We discussed all of them. So the policy types, individual insurance can be of any previously discussed or temporary or permanent, of course. Is annual policy type is annual renewable. Is annual renewable. Term life insurance is annual renewable. Group life insurance that we have at work is equally annual renewable. That's why you have enrollment period every year. Every year you have enrollment period. That's why you have it. That's because it's annual renewable. Converting group insurance to individual insurance always requires a conversion to a permanent policy. So if you have group life insurance, such as the one I have when I was working, you can convert it from individual insurance to a permanent policy. I did that one recently. I just sent them acknowledgement of receipt of booklet. I just sent it to them today. So cost of insurance, what is the cost? What motivates everybody in insurance and what can diminish your motivation is cost. Cost is always a factor in the policy, in getting a policy. Because you want to get a policy that you can afford. So, but sometimes when you look at the severity and the importance of it, you're going to get as little as you can be able to afford. You're going to force yourself to readjust your spending to be able to accommodate it, because it's a protection that you must have, that everybody in the household must have, no matter how small it is. Should be a requirement in every home. So individual insurance policies are more expensive for the insurer to issue because there'll be underwriting, commission, billing, and maintenance costs. All of them are, you see all of them in individual as compared to group life. But however, I still doubt why we pay much on the group life and why sometimes somebody can get up to 200,000 in individual term life and be paying around $200 or $100 something every month. I think some people have it. Some people have up to 200,000. They are up to 150 to 200,000. They're paying up to around 150 or up to $200. So group insurance policies are less expensive for the insurer to underwrite. Of course, in the underwriting, because underwriting is done as a group, but in individual, underwriting is done as individual. That's why there'll be costs for underwriting costs, commission costs, billing costs, maintenance costs, and also other costs that will be attached to the premium. So in some cases, the employer or your sponsor may pay most or all of the premium costs for the group policy. This is why what you're going to find out in your company, whether they are paying part of it or you are paying all. So with individual insurance, the customer policy owner is always responsible for paying the entire premium cost, of course. So since individual insured do not own or control the policy, that is for what? For group life insurance. Individual insured do not own or control the policy. They are issued a certificate of insurance, often referred as a certificate of coverage and benefit, to serve as evidence of their coverage. The actual policy, referred to as the master policy, is issued to the employer who becomes the policy owner. All right, so I think that is it. Contributory and non-contributory. We have said much about contributory and non-contributory. Find out from their company how much they are contributing. If they're offering you contributory plan, find out. If it is non-contributory plan, oh, great, glory be to God. Ask them how much policy do you have? So this is what you have to know. In fact, it's like tomorrow, you have to know it. Even if you're not going to do anything because you already signed already, you're not going to do anything. But at least know it for knowing sake. Know it to confirm what we are saying. You have to know those things in your workplace. You have to know it's something required that you should know it. So, non-contributory plan. Under this plan, the employer pays the entire cost. If it's not contributory, then the employer pays the time cost. All the cost means that in your paycheck, they should not be removing your money if it's not contributory. The insurance company requires that 100% of all eligible employees participate. The most significant benefit of a non-contributory insurance plan is that it helps the insurer avoid adverse selection. Of course. So if the company is offering non-contributory, meaning that they will not be taking from your paycheck any amount. Meanwhile, you have a plan. You have a policy. Then you don't have any option than to accept it because you're not paying anything to it. Yeah, then it becomes a good thing. So in that case, they require that 100% of all employee is eligible to participate. 100%, which means everybody must participate if it's not contributory. You are not contributing any dime to it. Your company is paying. Then jump into it. Jump into it. And in that case, of course, you'll be forced because 100% of employee must participate if it's not contributory. Then if it's contributory, you now have the what? You have the chance to say, I do not want to contribute if you do not want. If it does not meet your requirement, you can decide to opt out. You are not forced to have it because it's not it's contributory. You can decide that you don't want to contribute. You have already had a good plan. Like some of our brothers and sisters, if you ask them, talk about life insurance, they will say, oh, I get it all. I get it my job. So you get it all. You can decide not to be part of it. If you by now you know the calculation, by now you know what it means. By now, you know everything about life insurance. More especially when you begin to be a producer, you begin to write policies for people. You begin to design your own future by yourself. You go to your job, you check that this company is contributory. You check how much you are contributing. Take it to calculate how much you be paying on the policy you will have, individual policy like permanent policy, life insurance policy. You do the calculation, you see that you'll be wasting money if you're paying for this not contributory plan that you have when you are a job. Is there need to continue to pay it? It's optional. You can opt out. At least 75% of eligible employees choose to be covered or participate. You are allowed either to opt out or to opt in. So if you know the rating, you do your calculation. If it does not match what you want, why you stay here? You opt after the plan. Are you going to be sacked if you opt out? No, because it's contributory plan. You don't want it. Oh, I have it all. Say just I have it all. You go out and do your individual policy that will cover you at least the whole life of the person. Than the one that cover you when you leave the job, you don't have nothing again. So it's something that all of us should do. Do the mathematics by yourself, do the minus, do the addition and subtraction. If it favors you, go. If it does not favor you, go and look for something good for yourself that benefits you even when you retire. So that is a assignment to everybody, honestly. Now, eligible groups and group members. I'm seeing what we have to do here. So only a natural group can be eligible for a group insurance policy. A natural group is a company, is a natural group. insurer will not issue group life insurance policy to group whose primary organization purpose is to purchase group life insurance. So if you go and gather everybody, say they should come together so that you guys will have a group coverage, the insurance company will not cover you guys. So please, they will not. They will not. Because the purpose of the organization primarily is to purchase a group life policy. They will not.
Why is that?
Huh?
Why?
Yeah, because your purpose is only to get a group plan. No. You must have a different purpose. Then you go to get a policy in a group. But if you go and gather 100 people today, say, come, let's go and contribute money and have group plan, they will not give you. It's against the law, they will not. But if you have a group who their main purpose was not for insurance, you are doing a different thing, you cannot go for policy. Our people, I'm from Imo State, my local government area, I'm from Idato. So there was a time we tried to organize a group policy for our members. We are close to 75 to 80 people. So we tried to organize a group policy where if anything happened to any of us, from the policy, the money will come out to take care of the person. If the person is sick, that was our main target. But behold, we go for it, and somebody came to a session one day to one agent, come to ask us questions, come to teach us about it. Of course, then I do not know nothing about insurance. So come to teach us policy. At the point, said he did a calculation. Based on his calculation, the premium we want to pay. We check on it is much that we can't even afford it. We stop. We stop. Yes. Because remember, if it's group, it's gonna be the underwriting will be a group underwriting, so it's supposed to be cheap. But based on the age consigned, it was much, so we couldn't afford that. So in that case, you can see that our group was not specifically meant. We didn't form the group to go and buy policy. No. But if you form the group to go and buy policy, definitely they will not give you. They will not. So
Can I ask a question?
Go ahead.
I want to go back a little bit about the contributory and the non-contributor. So are we talking about the employee who contributes, or are we talking about the employer? And I'm a bit confused.
All right. When you say contributory and when you say non-contributory, when you say contributory means that the employee and the employer is contributing to the premium.
Right.
Then when it's non-contributory, it means that the employee is not contributing to the premium. It's only the employer is paying
full. Okay.
Yeah.
Okay. Yeah. I got it. Thank you.
You're welcome. So any other person? So if group that purchase group life must also meet minimum size requirement. Generally, a group must have at least 10 members to qualify for group life insurance. However, that group should not be formed for the purpose of group policy. Though states may impose additional standards. So the person that asks why won't a group who formed for purpose of insurance be given policy is against the state law. States have standards that any group must meet before that group will go for group insurance policy. Yeah, the states must be able to meet state standard. So it should be noted that this standard for group life policy differ from what standard used in group medical insurance. So remember, what we are talking about here is life insurance. We have not started talking about group medical insurance, of which we still see after now. That is, I think, chapter 9 or what. We're going to talk about group medical insurance. What we are discussing here is group life insurance. We have not gone to group medical insurance. when we talk about HMOs and PPO and all the rest, we're still going to see them not here. All right. So eligibility of group members, employees. Of course, every company have their own eligibility. Some of them will say, if you're not full employer, they will not give you. You'll not be, enroll in the package. If you're contract staff, no, nothing for you. If you're part-time, nothing for you, except you are full-time. That is when they will consider you to give you the package. Of course, it depends on every company. Some companies, if you're working as part-time employee, they still give you the package. And the contributor and non-contributor, again, will depend on whether you are working part-time or you're not working part-time. So I want everybody to remember this thing I'm going to highlight now. Probationary period. Yeah, you may see it in exam. If you have your paper, remember I told you anywhere you see this period, write it down and write what it means and write what the period is. It's confusing. A lot of it is here in this review class, a lot of it. If you go to group medical insurance, you see a whole lot of it, period. We have talked about all the periods. So whenever we meet any period, I want you to write it down. That will remind you of what it is because there's a whole lot of them. So in this case, we are still going to meet probationary period. But for this group life insurance, it's between 1 month to 6 months before they become eligible for coverage. What that probationary period means that if you buy a policy now, they give, let's assume you buy a policy today. That policy may not be effective today. It may be from social period, maybe from social time. Within those time that's open, they use it to see whether there's anything that's related that will be negated. Now we negate something. Probably you have any health condition that is beyond they did not cover. They want to, that was they give you probationary period. We are still going to look at it well when you get to it, but I just want to give you insight of what it is. So I want you, when you get to that point, write probationary period and write what it means. It's typically 1 to 6 months before they become eligible for coverage. Of course, if you employ today, that day, they're going to give you 1 month or 6 months. So the month of probation in your job is equal to the probationary period for your health insurance. So it becomes full when that probationary period passes. Of course, different companies, 6 months. Some is 3 months. You enroll for the policy, it will not be there until you've passed your probationary period. That is when you now become qualified as a member. So what's eligible? There is an initial enrollment period for contributory plans. During the enrollment period, an employee has 31 days to enroll. So you have 31 days to enroll. The enrollment period is always 31 days. I think it's almost every November. Otherwise, the employee may need to provide evidence of insurability later. So when you are after the probationary period, you have 31 days to enroll. If you do not enroll, you have to go to the individual. By then, they will ask you for evidence of insurability. So let's look at this. If the plan is non-contributory, employer pays the entire cost. All eligible employees are automatically enrolled. I've never seen any company who do non-contributory. Please, if your company is non-contributory, means that all the employees are covered and they pay nothing. Please, you can tell us. Non-contributory, where the employer is paying all the money. All the premium, I mean. Underwriting requirement for group life insurance. Of course, in the morning we deal seriously about underwriting. We deal about underwriting. So we're not going to do much on it again. We know that why underwriting process coming because of adverse selection, which is the tendency or danger of an insurer.
Excuse me.
Go ahead.
I didn't get the 1 to 6 month the probation.
All right, what we are saying for 1 to 6 months is that if you get a job there's always a probation or probationary period at your job. Is that true?
Yes, yes.
All right. So
I got no. It's okay, but it's okay now.
all right. So it just link it to the insurance. The insurance starts immediately after the probationary period. After the probation, they give you 31 days to enroll, or otherwise they will ask you for evidence of insurability. So that is just the meaning. Yeah.
Thank you.
But as we go on, we're still going to see probationary period, what it means in terms of you enrolling in your medical insurance. You see what probationary period means. So in some individuals, all right, some individuals are covered under group policy. There is higher probability that a bad risk will be included. Of course, when you have group plan, some of them will be, some people may be sick, serious sick. Some people who may not be qualified for an individual plan, in the group policies, what they do, they are qualified because it's a group plan. So those bad risk is what some of the companies do not want to have. That is why if you form a group, it's one of the reasons why if you form a group, principally to go and do group policy, they will not allow you guys. But if that group exists other than getting a policy, like a company, they are good because they know sometimes companies have criteria of employment. There's some people they will not employ. Of course, if you're not heady, you cannot perform the job, the company will not employ you. So that again is somehow a checklist for them to help them in doing a group underwriting process. So if not, they will enter into advanced selection, of which they don't want to. No company wants to experience advanced selection. So know that, again, what you have to know is that in non-contributory plan, 100% of eligible group members must be enrolled. And in contributory plan, at least 75% of participation is required. So it can be among the 25% in contributory plan that say no, because you have known what it means. So go today, find out what you need. Based on what you need, take a decision and make sure you take a good decision. All right. Conversion to individual policy. Of course, when you have group plan, you can convert to individual policy if you leave your job. If you are terminated or if you resign from your job, as far as you have worked for so number of years, you can convert. Of which I told you guys I just did it. On the conversion, if you leave your job or if you are terminated or resign, you are given 31 days following termination or resign to convert your group life insurance to individual policy without proof of insurability. You have 31 days to do the conversion. Remember, in term life insurance, most companies will say after 3 years or after 5 years, you can no longer convert. I have a term life in policy, I'm just example to all this problem. I'm a very good example to all this problem. For those who don't know, I have my first insurance policy, term life insurance policy, 2007. Yes. That's the 2007 was the first time I have a policy. I have insurance policy. And it's just about 2 years or what about a year I came to America. So I have my first insurance policy, which is a term life policy. And who can guess how much it is? And that policy, we were in the office, about 14 of us or 11 of us in the office. So one man walked in during almost our lunchtime, walked in. All of us were just, in fact, we were at lunchtime. So all of us, the man walked in and he was talking to us about policy. He was given, our manager brought him in. He was given about 10 minutes to talk, about 5 minutes to talk to us. So when he talked finish, he entered into one private office where if you want to buy, you can go there to buy. So when the man finished, I have to walk into him. Upon 14 of us in that office, only me that bought a policy. So,
all right, Mimi.
So when I come out, the other people were asking me, some of the friends that asked me, but do you want to die? This under the buy policy. You see, that was the mentality we have then. Do you want to die? Why are you going to buy policy? I laugh, say, why you guys don't say this? Say, if I die, let my family collect the money now. Tell me, how much are they collecting? 80 something thousand. I said, if I die, let them collect the money. Let them collect the money. It's only me then that bought it. So I bought a policy because I do not know actually the right one to do. Neither the agent was educative enough to tell me what do I need. Then, if I can pay that money for that policy, I can be able to afford at least $200,000 to $250,000 policy, of which I can confidently pay. That is the basic truth. But because the agent does not know, the agent does not understand, he only told me what he can say to me. He does not give me alternative. Just like in those days, some of you here are ladies. Some of you have given birth to a baby. When you born your child, they will come to hospital. They will offer you what we call GABA. Who have known that GABA insurance? Anybody? Anybody here? It's like everybody
Yes,
here. Huh?
yes, I did.
Did they give you GABA?
Yes, they did. But again, just like you say, we had that mentality about, who I just have my baby. What you talking about life insurance? My baby is not dying. I want it. So that was my reaction. I didn't. I trashed it.
So imagine that time that you rejected that, you come back home and some agent come educate you and your husband well, you guys decide to put $1 million policy to that baby. Do you think you guys cannot afford it? Huh?
Definitely, yeah.
You guys can afford it.
Mm-hmm.
You guys can afford it. And it'll be, in fact, it will not be up to 100, in fact, it may not be up to $100 or maybe around $120.
Actually, it
For
was less than $100, as I can remember. It was very cheap.
all right.
Mhm.
So, but because our people, oh God help us. So we have fallen a victim. So we don't want those coming behind us to fall a victim. I think either Shay or somebody said he came to America last year. So you see, you are indeed fortunate enough to be here today, listening to this, so that you can begin now to organize yourself. Please do not go to any hospital. Make sure that you get your policy before you can go to get any diagnosis. Because if you enter hospital, you must get a diagnosis. That is the truth. That is the truth. So then if that guy had told me the right thing, I wouldn't have gotten term life insurance because I've considered the benefits thereof. I would have considered that, look, this policy will take me until I retire. I would consider that, look, this policy has a cash value that I can get something out of it. So there's no way I would have opted to buy term life insurance. But however, you know the saving grace, I would say, then you know what I asked that man? So what if I pay, I couldn't pay again? What happened to the one I paid? That was the question I asked the man. The man said, oh, I can put a return of premium rider to you. Do I know what is return of premium rider? I do not know. Say, oh, if you like, I can put a return of premium rider so that at any time, even you cancel, they will send back your premium. I said, put it. So he put a return of premium rider to my term policy.
Hallelujah.
So that is only what saved me. But other people, if you see other people who do not have return on premium rider to them, and they decide to terminate the policy or the policy terms in the sense that the year they paid for has gone, they want to renew and the cost become much they cannot afford, then it ends, everything goes. Both the premium they have paid goes. But if you have a return on premium rider attached to that policy, what happened? They're going to bring out the premium, remove all the expenses or what they have done, maybe all the expenses they have done on the policy. They're going to give you, they minus it and give you the remaining one. So at least instead of forfeiting everything, you get something out of it. So term life insurance is the only insurance that you can have return on premium. You do not have return on premium in whole life or permanent life insurance because of what? Those ones have what we call cash values. Remember, when you pay your premium on permanent life insurance or whole life, some of the parts goes to the cash value. So there's no way they can return the premium to you. So, however, the ones that go to the cash value are called non-forfeiture. You will still get it back no matter what. So that is it. All right. So the conversion period is always 31 days after you leave your job. 31 days. Within that 31 days, you are required to indicate that you want to convert. After that 31 days, you can no longer convert because you can no longer convert the insurance to permanent or whole life insurance. So you are given 31 days to convert. And within that 31 days, you are not required to show proof of insurability. You only convert and the premium continues. All right. All right, look at the, I don't want to, whether we need this, I don't, we don't need it, or we have said it all. All right, group policy termination and conversion rights. Can you terminate your group policy? Of course. You can decide that you don't want no more. In the event that the master group life insurance policy is terminated, when can group life insurance be terminated? The insurance company, the policy owner, the employer can decide to, if they close up, do you still have a policy? If the employers decide to close up, maybe they are no longer into operation, do you still have a policy? Of course, no. So if in the event the master group policy terminates, any insured member who has maintained coverage under the policy for at least 5 consecutive years is eligible to convert to their group coverage to an individual whole life policy, insurance policy. So if the employer decides to terminate, you cannot. But if you have stayed up to 5 years in that company, you can convert their group plan to individual whole life insurance policy. So invariably, what I'm trying to tell you is that even while you are working, if you have stayed up to 5 years, you are allowed to convert your group coverage to an individual whole life insurance policy. Of course, then they will say you are vested in the company. You are fully vested, means that you can operate, you can receive retirement benefits. So in that case, you can allow to convert. So meaning if you are 65 years, you retire from a job, you are allowed, because basically you must have stayed up to 5 years in that job, you are allowed to convert to individual whole life insurance policy. The question will be whether you can be able to afford the premium. So the converted policy may provide coverage up to the face amount of the group policy, subject to the insurance maximum limit, e.g., 10,000. So whatever you have there is what you have. Whatever you have in your company is what you're going to contribute. No medical examination or proof of insurability is required for conversion. Of course, they didn't ask me for any medical examination or proof of insurability. The premium for the individual policy will be based on the insured age. Of course, that's where they cut you. The premium now will be based on your age at the time of conversion and will probably be higher than the group rates. My dear, it's more than higher. Don't say it's higher. Higher is another statement. It's more than higher. Now, again, if you are 65, knowing fully well that the premium will go high, knowing fully well that the premium will be based on the insured age, you see that it'd be more difficult to afford, whether you're a man or woman. That's the truth. The insured must apply for conversion within 31 to 60 days following the termination of the group policy. So that's what everybody should know. Other forms of group life insurance, group credit life insurance. So remember, as we have credit insurance, which you say is about loan, now we can have group credit life insurance. We can have blanket life insurance. We have talked about all this. So group credit insurance are established for organizations, e.g. banks and finance companies, and stipulate that if the insured dies before a loan is repaid, the policy benefit will be used to settle the loan balance. Premium for group credit life insurance are based on what claims experiences and expense factors, not necessarily a borrower's age. The premium are typically paid by the insured. A decreasing term policy is commonly used. So all this we have discussed it. There's no blanket life insurance. We have discussed it before. Retirement lives, reserve, and qualified plans. All right, let's just look at qualified plan. People may have some questions to ask there. Retired Lives Reserve, RLV, is a group life insurance product designed to provide continued life insurance protection for former employees. RLR offers annual renewable term insurance and reserve account that accumulate funds until retirement. So this one is, of course, RLR, from what it says here, I've not heard about it before, is actually, it can be formed by, it's a policy type of policy that meant for people who have retired. So anybody can decide to have it. If fund continue to accumulate there until when the person retire. You can, if you have this policy, what does it do? It will be accumulating funds for you until you retire. It's just like a retirement benefit that you can invest your money. I think most companies, maybe most companies do not do it. Of course, all this we are talking about benefits in companies. There's no benefit in companies. The main benefits in companies are hidden. They will not want to invoke it. They want to use it. The only thing, the benefit the companies give you now is like group life insurance and dental and eye and medical. That's the only benefit they give you. But the ones that can benefit you, that can, for instance, this Retired Lives Reserve and Qualified Plan is a good one that somebody can have. That when you retire at your retirement age, you can get something out of it. In fact, any portfolio that does not provide for your retirement does not want to have. That's the truth. To me, to my understanding, if you have a portfolio that cannot serve you when you retire, there's no need to have it. Because at that time you are young, that you are still performing, you have your strength. Basically, you can do anything to help yourself. When you need all these things, when you get old, that's when you need it. So if at old age, those things cannot provide for you, then what's the basis of having them? That is my own personal understanding. If something you have cannot benefit you when you get up to 70 years, that thing cannot benefit you. 65 years cannot benefit you. That thing is temporary. Is there anything you need to have it? To me, I feel there's no need. That is my own personal opinion. So RLR can be of good plan for anybody who have it. It's a retirement plan that is a renewable term insurance that you can have that can accumulate until your retirement. So when you retire, you can start get money out of it. So that is the kind of plan I would like to have. Now, life insurance for members of the armed forces. The armed forces have their own life insurance. Everybody, I think most people who work with armed forces, all these veterans, if you ask them, they say they are fully covered. Of course, they are covered, but who has gone into their policies to see exactly what they have and how does it benefit them? So federal government provides life insurance coverage for those in the armed forces, armed services, and other federal employees. Service members group life insurance coverage. Service members group life insurance provides up to 500,000 in 50,000 increment to full-time members of the armed forces. The coverage provides is group term life insurance, and all active service members are automatically covered unless they opt out. So is there something as somebody working? Is it something as the group life insurance we have? So the service members group life insurance is the same thing as group life because it covered them up to 500,000, an increment of 50,000. So, and it covers you when you are full members of the armed forces. When you after what happened to the policy, you do not have it again. So it's like something, it's like the same thing we have at our different job, the group policy we have. When you're out of the job, do you have it? No more, you don't have it. So it's something like service members, what the service members have. Family service members group life insurance. What the group life insurance covers what is a component of service members group life insurance group. What it provides coverage for a spouse and children insured service members. Non-military spouse are automatically covered for 100,000 to the amount or the amount of members coverage, whichever is less. Premium for spousal coverage are based on spouse age and what? The amount of coverage. Dependent children are covered for 10,000 each at no cost to the member. So this one is good. This one is good. But they did not tell us whether it still remains if you leave the job. Just like I said, any policy, any portfolio does not help you when you up to that age of retirement, then that policy, to me, doesn't want to keep it. Because when you need it more is when you retire. Veteran group life insurance coverage, I think this one should be good because veteran group life provide for the conversion of service member. All right. So you can see that the service members group life, which is this one, service members group life, which is like the group life we have in a different job, their own difference that has 500,000 of at least minimum up to 500,000. So if you leave the job after the policy ends, but you can still convert it to veteran group life insurance coverage. So just like we can convert our own from group to individual, when you retire from your job after 5 years of work, you can still convert the service member to veteran group life insurance policy. So what now is that as it becomes your own personal individual group and renewable, can you afford to pay the premium? That will be the problem now. Can a retired service member who is a veteran be able to pay the amount that he's going to pay on that policy? That is a big problem, a big question. So veteran group life insurance provide for the conversion of service members' group life insurance coverage to a renewable term policy of insurance protection after a service member's separation from service. Service members and their spouse may be able to convert their SGLI or VGLI to permanent insurance through a commercial insurer without having a proof to prove insurability. The problem is not conversion. The problem is the premium. Can they afford it? That's the problem. Can they afford it? So federal employee group life insurance coverage. So this one is federal. Is provides group term life insurance for all other federal employees or civil service workers. Eligible employees automatically receive basic coverage unless waived, usually equal to their annual salary plus 2,000. So, in other words, a best instruction, a best advice, not telling the person what to do, the best advice will be, in as much as you get all these wonderful policies, it's still good to have your individual policy. In case when you retire from your job, you're not able to pay the premium, you can now retain the single one you have before. And remember, it's good to do it early because as you ages, the premium increases. So it's good to do it as early as possible. So, but people get confused. Most people in the military, they are strong-headed. If you talk to them, oh, I'm fully covered. Oh, I'm fully covered. Ask them what they have. They don't know. In fact, I have a friend. As I'm talking to you, I have a friend. He's a veteran. I've talked to this guy to come have a policy. Nothing that I've not said. You talk to him, he said, oh, no, I'm covered. Oh, no, I'm okay. I got it all. I got it all. Even last week we speak, he said he got it all. I said, come to the office, let's talk. Say, but I told you I got it all. But I continue to talk until he come to office to listen to me one day. So premium taxation of group life insurance, of course, there's no tax in anything insurance. You guys should know it, there's no taxation. So anything in tax insurance, there's no taxation. It's tax deductible. Why is it tax deductible? Because except if you have a policy that has a cash value that's cumulative, cash values are accumulating, the accumulation may be taxable because outside the cash value. Just like if you have a dividend, the accumulation on dividend is taxable. So proceed for group life insurance is tax-free. It's not taxable. Please know that. Chapter summary. All this is what we have said. Oh, thank God we finished chapter 8. So we're gonna just do the question fast, so we can end today. So tomorrow morning we start chapter 9. That's good. So let's listen to this and do the question fast.
Congratulations on completing group life insurance. You've just explored one of the most important benefits offered in the workplace and a key area for your state exam. Let's review what you've learned and lock in your understanding. First, we discussed how group life insurance offers coverage to a group of individuals, typically employees, under a single employer-sponsored policy. This structure not only simplifies administration, but also makes coverage more affordable and accessible, especially for those who might not qualify for individual plans. It's a cost-effective way for employers to support their team's financial well-being while giving employees peace of mind. Then we compared group and individual life insurance. With group coverage, the employer or organization owns a single master policy that covers all eligible employees. Instead of receiving individual policies, employees are given certificates of insurance, which serve as proof of their coverage and outline their benefits. This setup simplifies administration and makes coverage more affordable. In contrast, individual life insurance means each person owns their own policy, selects their coverage, and is responsible for the premium. Understanding this distinction is key. Group insurance is typically easier to access and less expensive, while individual insurance offers more customization and control. There are two main funding methods: contributory plans, where employees share the cost, and non-contributory plans, where the employer pays the entire premium. In a contributory plan, both the employer and employees share the cost of premiums, and at least 75% of eligible employees must participate for the plan to be issued. This approach allows employees to contribute through payroll deductions, making coverage more accessible while still keeping costs low. In a non-contributory plan, the employer pays the entire premium and 100% of eligible employees are automatically covered. This method ensures everyone receives coverage without any out-of-pocket expense for employees, and helps insurers avoid adverse selection by including all eligible members. Understanding these funding methods is important because they affect who pays for coverage, the percentage of employees included in the plan, and its overall affordability. Eligibility is key when it comes to group life insurance. First, the group itself must be formed for a legitimate purpose, such as employment or membership in a professional association, not simply to buy insurance. This ensures that coverage is a genuine benefit, not the sole reason for the group's existence. For employees, eligibility usually means being a full-time, actively working member of the organization. New employees are subject to a 31-day probationary period before becoming eligible for benefits. After this period, there is a designated enrollment window during which employees may enroll in coverage without needing to provide proof of insurability. Now, when it comes to group life insurance, underwriting is all about evaluating the group as a whole, not each individual. This approach helps insurers manage risk by relying on the law of large numbers, balancing out higher-risk individuals with lower-risk ones to keep premiums affordable. Larger groups usually don't need to provide proof of insurability, but smaller groups might. Importantly, employees with physical impairments can't be excluded from coverage. Insurers also look at something called persistency, which is the percentage of policies that stay active over time. Groups that maintain their coverage are seen as more stable and less risky, making them more attractive to insurers. Next, you learned about a valuable feature of group life insurance, which is the conversion privilege. If an employee leaves their job, they may convert their group coverage to an individual policy. This conversion shifts the coverage from temporary to permanent, with no proof of insurability required. This means life insurance protection can be maintained even after employment ends, without the need to qualify based on health at that time. It offers a straightforward way for employees to retain coverage during major life transitions. You also looked at beneficiary designations. While the employer owns the policy, it is the employee who selects the beneficiary. We also explored special types of group coverage. Credit life insurance is designed to pay off a loan if the insured borrower passes away, protecting both the lender and the borrower's family. Blanket life insurance covers groups exposed to specific hazards, like airline passengers or students, providing temporary protection without naming individuals on the policy. Qualified plans may also include life insurance as part of a broader retirement benefit, ensuring employees and their families have ongoing protection even after leaving the workforce. Tax treatment matters. Employer-paid premiums for group life insurance are tax-free to employees up to $50,000 of coverage. If the coverage amount exceeds $50,000, the value of the extra coverage is considered taxable income and must be reported by the employee. This distinction is important because it affects how much coverage is truly cost-free and what portion may result in additional taxes for employees. These concepts equip you to guide clients and make well-informed choices about group life insurance coverage. Keep going, and I'll see you in the next chapter.
All right, I think we are just done with this chapter. So tomorrow we talk annuity. Remember, we just did annuity just 2 weeks ago. So you can see how fast we are. So let's answer this question tomorrow morning. We're gonna start with annuity. Annuity is one of those chapters that you need to know. All right. Let's remember, use elimination method. We have only 12 questions to answer here. Under a trustee group life policy, who would be eligible for a certificate of coverage?
Employees, C as in cat.
Any other person?
C.
Of course, that's what we said. Employees should have it. Which of the following is an important underwriting principle of group life insurance? The underwriting principle of group life insurance, which of the following is important?
D as in Doko.
Any other person?
C.
Right. Who supports C? Who support D?
Employee must be covered.
C.
Everyone must be
The
covered.
2 persons say C.
I think C.
He says C.
Yes.
Yes.
Bro, everyone must be covered in the group. Yep. Which contributory plan is that? Is it non-contributory or contributory?
Non-contributory.
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 All right, yeah. Non-contributory, everybody, 100%. Contributory, how many percentage?
75.
75, good. Of course, the question has been answered. So a non-contributory plan requires
That's
some
75.
participation. So non-contributory.
75.
75.
Non-contributory.
Non-contributory 100.
Oh, 100, sorry.
You guys confused. All right. An employee with 25,000 group term life coverage was recently fired. This employee group coverage may be converted to a what?
Converted.
That's a permanent.
A.
The
D.
individual whole life.
A.
That's B. Uh-oh.
B as in dog.
D as in dog.
B.
All right.
Whole
So
life.
the answer is D.
Yeah.
He has 25 group term life when he's at work, and he was fired. So he's gonna convert the 25 to individual whole life. Company XYZ offers a group term life insurance policy plan to its employee. What does each employee cover under this plan receive?
Certificate of insurance.
Certificate of insurance.
Even though they don't give us.
B as in dog.
See, let me tell you people. Somebody asked this question, and I want to tell you guys. You see, this question, how many times has it come?
That's the third time.
Huh?
3.
Two.
2, yeah.
Or three, two or three times. That is exactly how it is in the exam. So if you see one question, after you see it again, don't feel that you are failing it. It's correct because this question populates as you write, as you go along, it populates. Whatever you see is what you answer. So don't be surprised you answer one question 3 times. Yeah, don't be surprised. If you see it, just go ahead and continue your question. It can happen because whatever comes out is what you answer. Then which provision is not a requirement in a group life insurance? Which provision is not a requirement?
Incontestable. See.
Anybody say what?
Do they in contest?
It's not a requirement. Look at this word, not NOT.
That's incontestable.
A.
Anybody supporting A?
Inconvalid.
A profession requirement.
Yeah. We haven't said anything about accidents of them, so maybe it's A.
Two persons say A. Of course, conversion is there. Incontestable period is there. Grace period is there. So it's A. Nobody talk about A in this group. We finished. We started group now, and we finish it. Do anybody hear what we say? Accident. So an employee of 20 years recently retired at the age of 59 and a half. The employee's group life contract can be what?
The employee of 20 years recently retired at age of 59 and a half. The employee life contract can be.
Yeah. Could that be A?
Another person supporting her?
Competent to an individual permanent policy at individual rates.
D.
Continue.
Another person supporting her?
At an individual rate.
I'll go with A.
A is as an apple.
I would say A.
A.
A. Converted to individual permanent policy at an individual rate, of course.
A.
The question repeated again, right? Something like this came earlier, right?
So what type of group insurance plan involves employees sharing the cost?
Contributory.
Contributory.
A.
It's contributory, of course. Which requirement must be met for an association to be eligible for a group life plan? For associations to be eligible for group life plan, what somebody asked that question and they explained it well.
B.
B, I think.
B.
Person said B. Of course, the group was formed for a purpose other than acquiring insurance. So group life insurance policies are generally written as what?
Group whole life.
Term life insurance. Annual renewable.
D.
Yes, in David.
Doesn't say annual renewable. Is annual renewable?
Yeah, D.
Is annual renewable. That's why you do every year you do renew it every year.
Open enrollment.
Open I used to forget that open enrollment. So I think that's it. We get 100%. So tomorrow morning we start with chapter 9, annuity. Annuity is an interesting chapter. Some people go to the hall and almost half of the question they will see is annuity. So if you do not know anything about it, it becomes a problem. We just did it about 2 weeks ago, 1 week ago or what. I think if somebody is here with me, we just did annuity when somebody was going for exam. We helped her do annuity, and I think the person passed. I hope so. Yes, I did. The person passed. So we're going to do annuity, except if anybody is going for the exam in the next within the week, and you have a particular chapter you think you don't understand. We can help you to do that. You tell us the chapter. We can suspend any other chapter and do it tomorrow. That's definitely what we do. So any chapter you think that you do not know, and you are going for exam, you tell us, we can repeat it for you. We can abandon anything and go to that chapter and do it for your sake to show that you pass. So we're going to do annuities tomorrow. Everybody should log in if you're available. Log in. Wherever we stop, we complete it tomorrow evening. And annuity, I think, is a very big, is big chapter, but it's very, very interesting and chapter that everybody should know. You should know why you must invest. You can see we're going to step out from talking about insurance protection. We're going to step out a little bit, start talking about retirement and investment in annuity. Annuity is that type of policy or that type of investment portfolio that can give you stream of income for life while you are still alive until the person passes. So you can see, you can't bet it. The best thing somebody can do is to get at least, no matter how small an annuity, get an annuity. It's good for you. And moreover, it helps you when you get retired. Just like I said before, any portfolio that cannot help you when you retire, that portfolio does not worth getting. That's the truth. But because the problem becomes when you retire, what will happen? I think that is the major thing. When you retire, what is going to happen? If you retire, when probably the children are not there to help, you don't want to bother them. Remember how this place is. By the time the children will be on their own wahala to do with their own families. So you don't need to bother them. You be on your own. Any day they drop in to say, Mom, Dad, how are you doing? You say thank you. Until the person will join the ancestors. That is how the world is. So they may not be available. Of course, they'll be working to feed their family. They may not be there for you. And that does not mean that they don't love you. That's the truth. That does not mean that they don't love you. They love you, so much love you. But situation have made it that they cannot leave their job to come and sit with you. But if you have a retirement, good retirement plan, a good annuity, and long-term care, you can take care of yourself. Even if you cannot, you can get somebody be paying. The person will take care of yourself until they end it. So we're going to look at annuity tomorrow. We'll be talking about more, especially of investment. Remember, we say life insurance is not an investment. And remember, we say life insurance creates estate. And we're going to see tomorrow how annuity will liquidate estate. So that's basically when we're talking more of about investment. So I see you guys tomorrow. I hope everybody has registered for the exam. Remember, we have our Champion Bowl in Dallas next week. I think that should be next week. Yeah, next week, 5th February to 6th February. So I would like to see everybody at Dallas and come there and learn. Come there and get, more especially, I'm most particular in the business. Remember, every business have a guide book, the guide book, I think booklet or what, that guides people on what to, a product guides that guide people what the product is all about. So we do not have it even while we are teaching, but if you come to Dallas, you can pick as many as you like from different insurance companies. So you can use when you start your business. It's very, very good. Some people are doubting Thomas's. When they will doubt, you bring that booklet, say, take, go and read it. They read it and they'll understand one or two things while you zero them in to talk to them concerning why it's necessary for them to have policy. So see you guys tomorrow. Good night, and everybody.
Thank you very much, sir.
Thank you.